Hey everyone, this is Dr. Duru from Ahan Analytics with the market breadth. All right, quick timestamp. It is August 8th, 2025, well after market close. Here's some of the biggest headlines. I'm not going to go through them because I want to jump straight into the charts. It is a it was a fascinating week. Last week I talked about how the bears broke in on economic and political turmoil, headlines, and so forth. Well, the Bears were summarily kicked right back out on Monday to start the week. So the big drop I was hoping for that would wash out sellers just did not happen. It seems to never happen the way I want it to happen. And buyers just stepped right in as if nothing happened last week. But, and this is a huge conditional. Let me change this to regular. Market breadth did not really repair the way I would have liked it to. Now, yes, it recovered all of its losses from last Friday's big drop. Actually, most of the losses, not quite all. So this is AT50, the percentage of stocks trading above the 50 moving averages. I call it AT50 for above the 50. You could see here that on Friday, this is what caused the big concern. It dropped to a close of 43%. But Monday, it surged right away and almost closed the gap in one day. And then on Tuesday, it finished closing the gap, but then market breadth drifted back downwards. This is important context for what I'm going to show later because, yes, the buyers jump right back in, but market breadth didn't fully heal, which means that the bearish divergence between market breadth and the S&P 500 and the rest of the stock market is actually worsened last week. So before I show you what that's all about, let's check out AT200, the percentage stocks trading above the 200-day moving averages. So it too recovered last Friday's big drop very quickly, and then it just stalled out. So it's far short still of where the S&P 500 made its previous all-time high earlier. So it too is supporting AT50 in this bearish divergence story. So what am I talking about? Well, look at S&P 500. The buyers jumped right in. On Monday, the S&P 500 gained 1.5%. Sure, it pulled back, but look at how neatly it followed the 20-day moving average upwards, and it closed almost at the closing all-time high. And on top of that, it's close to invalidating the bearish engulfing pattern that last Friday's big plunge confirmed. So the S&P 500 is looking good. Like I said, I didn't get the follow-through selling that I wanted to get that would have provided the golden buying opportunity. But the S&P 500 remains well supported as I keep arguing. Now the NASDAQ did even better. It not only well, let's just make it simple. It made a new closing all-time high. It didn't quite. That's funny. The technicals can always be amazing. Look at that. It closed right at the intraday high, which was, let's just call it 21,457. And look at that. It closed at 21,450. So right under the intraday all-time high, but it is a new closing high for the NASDAQ. Who's the laggard? Well, IWM, the ETF of small caps, is a laggard, but it too did recover all of the Friday gains. So what's happening here is that there are a few stocks that are driving the indices. We can guess who they are. And unfortunately, a bunch of stocks are still being left behind. That's why I say the bearish divergence is even worse this time, is because we have the indices recovering all the losses, but the market breadth is recovering all the losses, but isn't yet following back up to even its previous highs. So, the overall implication is I'm just going to stay neutral on the market. Um, we have Jackson Hole from the Federal Reserve later this month, so that will probably be a positive catalyst given where we are with Fed drama. And let's take a look at the VIX. The VIX also confirms the bullishness. Look how fast um, it dropped right back. Not only did it reverse all of um, last Friday's surge right away, but it practically fell to a new low in this whole cycle. So it is definitely trying to say, hey, the market is bullish all systems go. Everything's clear for buyers to buy. All right, so that's the context. The context is we're still in this bearish divergence between the indices and market breadth. To me, it got worse last week, but it's still not a reason to get bearish because the market could keep dribbling up for who knows how long, even though remember, this is the seasonally weak period for the stock market where drawdowns tend to be their biggest in August, September, and October. But these drawdowns also tend to be opportunities, so they are times to buy. So, now with hindsight, I see that the first day of the month, Friday, for August was that big drawdown, even though it didn't quite get to the maximum drawdown for an August. Okay, so let us jump into some charts really quickly. I have a lot I want to show because there was a lot that was happening. Let's first talk about a few of the disappointments, starting with XLF, the financials. So you can see for the financials, I really thought that if anything, it would start to follow the rest of the market. But see how the financials did not quite recover all of the losses from last Friday when the bears broke in, and it's just following along the 50-day moving average. But this financials are part of what's holding the market back in terms of creating this bearish divergence. So we really need financials to get back on the horse. I was pretty bullish up here. Looks like my call options are going to expire worthless next week because I got a 53 strike. I think it was a 53 strike. And I mean, just this bad action tells me that XLF is in no hurry to get back to that level. Okay, so let's jump into a few. A lot of these had earnings reactions. SportRadar Group. This is one I'm watching just because it dropped post earnings 5.7%, but it's holding its 50-day moving average. And you can see on Friday, sellers tried to break it down, but SportRadar Group, ticker symbol SRAD, jumped right back. So I want to see if this is a candidate for a post earnings reversal. And as I'm also intrigued because it's a European company that provides sporting data, I think, for sports betting and that kind of thing. All right, HLOS. Of course, these are, just to note, these are, oops, not HLOS. Sorry about that. I don't even know what stock that was. AMRC. Some of these stocks are unknown stocks that I just found by scrolling through the big earnings movers. So this one intrigued me because it surged almost 50% post earnings. Ticker symbol is AMRC. Company is Ameresco. And then it immediately reversed. And you can see it's hovering above its 200-day moving average, still holding on to a lot of its post-earnings gains. So I put this on the buy list because I want to see if it can test. Look at how neatly its support is converging. 200-day moving average, the blue line, 20-day moving average, the dashed line. So that is on my buy list to watch. And as a reminder, I'm providing this information for educational purposes only. Please use your own time horizons and risk tolerance and risk management to make your trading and investing decisions. All right. Big disappointment was Atkore, sorry, ticker symbol ATKR, Atkore. Now, when I looked at the headline earnings, it seemed fine. So something spooked the market to the tune of 26% post earnings drop. I went ahead and sold a put. So far, so good. The stock is hanging in there. I also sold it because it was close enough to the April trauma, and noise from tariffs. So it's close enough to those lows. I am making a bet that those lows will not be violated, but we will see. SoFi got on my radar. It dropped post earnings, but then bounced right back. And now it's kind of in this, it returned to this price consolidation pattern. So simple trading rule for price consolidation patterns: a breakout is bullish, breakdown is bearish. That's all there is to it. So the breakout here, let's just say it would be about 23.20 for SoFi Technologies, ticker symbol SOFI. Even though the intraday high on earnings day was much higher, let's see, it was 25.11. And you can see there's also another day where it faded hard from 24. So actually the breakout for SoFi could be pretty tricky because if it trades in any of those areas, say between 23.50 and 25, it's prone to just fade right back. But the a bearish breakdown is much cleaner, much clearer around what is this, 1988 or so. Okay. Mondelez caught my interest because it dropped post earnings, and I'm hearing speculation that people are wondering whether GLP-1 drugs are getting to the snack group. So you can see it dropped post earnings and it continued to drop below 200-day moving average support. So Mondelez International, ticker symbol MDLZ, is now bearish. DoorDash is a stock that I went from bearish to bullish on, and it had a nice post earnings pop, but then it immediately reversed all those gains. I decided to sell my holdings. It was supposed to be a long-term holding, but this post earnings surge above the upper Bollinger Band just made me nervous, made me suspicious, and looks like I was proven out a little bit here with this reversal. Now, DoorDash is far from bearish, and I suspect more dips will be more buying opportunities for DoorDash. Ticker symbol DASH. Now, Duolingo. Check out Duolingo. Big time earnings moves. It was in bearish territory, as I pointed out, below the 200-day moving average, but but it had a huge post-earnings surge. I believe it got up as high as maybe a 30% gain, but then faded all the way back to just a 13.8% gain. And I'm showing Duolingo, ticker symbol DUOL, because this is another great example of the caution you must have when you see a stock that fades post earnings on that same day, like zips up or gaps up really high, but then fades hard. And you can see what happens. Sellers followed right through the next day, and that's today, actually, Friday, August 8th, with another 5.3% drop. And now it's up to the 200-day moving average again to hold on to support. If that fails, I suspect Duolingo is just going to proceed to reverse all of its post earnings gains and maybe even go lower. Fun just happened across my radar, and it took my interest because I was just at Magic Mountain with my uh, kid and his friends, my son and his friends, and they had a great time, but the stock did not. Look at this. Fun dropped a whopping 20.8%. I didn't have time to check out the exact headlines on this one, and sellers followed through again today. Let's go to the long-term chart just to see how bad this was. Um, you can see Six Flags Entertainment Corporation, ticker symbol FUN, hasn't been this low in 5 years. Now, of course, that gets my contrarian radar up, but I am going to be patient. I mean, after a stock drops this much post earnings, there is absolutely no rush to get back in. A potential point to get back in is a post earnings high that goes above the intraday high on the day of earnings. Okay, Snap. Snap was not fun. I have a position in Snap, and I've written about why, and it's all mostly because of the board member that joined from Yahoo. But Snap has just not been working out. Ticker symbol SNAP. I don't have a strict stop loss point on this one just because of my other narrative that I'm betting on. But of course, if it goes lower than the April lows, I'll have to reconsider this holding altogether. And similarly, Pinterest had a big post earnings decline. But it's actually looking a little bit better than Snap. Buyers tried to take the Pinterest, ticker symbol PINS, back to 50-day moving average support. Couldn't quite do it, but at least it's still well off the lows. All right, Toyota Motor. I talked about this last time, how it had a nice pop on good tariff news for Toyota, 13.6%, but the sellers immediately took it down, tested 50-day moving average support. I totally neglected to try a buy there, and the stock rebounded pretty neatly. It had a little bump after earnings or going into earnings, but now has resumed. So this was a nice trade in both directions, either to short it as a fade or to buy it on test of support. So that's Toyota Motor. I've been trying to keep my eye on the digital marketing companies, but they just keep getting crushed and disappointed. Sprout Social, ticker symbol SPT. I've been watching this for a long time for a buying opportunity, but the stock just never looks good, has not looked good in such a long time. I guess last it looked pretty decent right here in late 2023, early 2024, and it just is not showing any kind of signs of tradable life. So it dropped again big time post earnings. Actually, the weird thing was it gapped higher and then it just fell like a rock. Closed at an 8.2% loss, and sellers followed through in again today at a 5.43% loss. And yeah, this is what I was afraid of. This stock is almost back to its pandemic lows. And you can see here from the larger perspective, it essentially has been in an overall downtrend since reaching the peak in 2021. So this company has yet to figure out a way to truly recover. So I just keep watching it. Maybe, this company is done. Well, I don't mean done in that the company is going to go bankrupt, but just the stock in terms of being investable is done and is just not of interest anymore. Along these lines, too, I do have holdings in Semrush. Semrush is one I dared to buy. It also disappointed on earnings. Sellers also kept following through all week. Semrush, I think, is at an all-time low. Yep, it's testing an all-time low. So this is really a shocker to me. There's a period of time when it was doing really well on a recovery move from 2023 to early 2025, but this year has just not been Semrush's year. Um, yeah, I haven't decided what to do with my holdings here yet because I still think the overall thesis is good. But with so many digital marketing software companies falling off, something else might be going on. And I suspect it could be AI related in terms of deep research taking the place of the need or companies' felt need to buy these software platforms. But that's yet to be determined. Okay, here's another one that's been really suspicious. I think if I short this stock, Salesforce, ticker symbol CRM, it might recover, but it's been surprisingly weak. Even though the NASDAQ is at all-time highs, it's had a great year. CRM is down for the year. Um, it also, uh, had a brief recovery from the April lows. And let me see, I'm putting up the 12 month just so we can see just how badly CRM has been doing this year. It is down, yeah, it is down 28% this year. I mean, that's just shocking for such a blue chip tech stock. And it's suggesting that there could be something larger going on in the software space or the SaaS space. So technically, CRM was a short when it tested and failed at 50-day moving average resistance. Now it's too close to the April lows to make it a good short. So I'm just going to keep watching it. If it bounces, I would love to buy it for a bounce at least back to the 50-day moving average resistance. Datadog, this one also was a major fade play. Surprisingly, it it seemed like it was going to hold 50-day moving average support, but then it gapped up and then crapped all the way down to a flat close, and sellers followed through today. And it now Datadog is teasing with bearish territory, closing below 50-day moving average. This is important because Datadog was just added to the S&P 500 and it surged 15%. I was lucky enough. Um, Sorry, not this stock. I was lucky enough to keep an eye on this when it fell down and tested 20-day moving average support. I bought it and then I sold it around here as momentum clearly um, lost steam as it approached the S&P 500 inclusion high. So, and plus I didn't want to keep the stock through earnings, and it looks like that worked out pretty well. What didn't work out pretty well is Gartner. Oh my gosh, this one shocked me because I thought, Gartner, ticker symbol IT, is just one of those blue chip companies that's defensive even. It's in IT, but it's an information provider, research provider, seemed pretty safe, but no, it completely collapsed post earnings by 28%. Now, headline earnings look just fine. When I looked a little deeper, it seems like there could be some fear that the AI research platforms are slowly going to eat Gartner's lunch. Now, clearly, that's a narrative that the market believed for all the rest of the week because sellers were in control. Gartner is now down, I believe, to a 2-year low. Yes, actually no, it's a 3-year low, and it's going to flirt with about a 4-year low very soon. So again, the contrarian me wants to find a buying opportunity here. I mean, Gartner is now, what is this, over 50% below its all-time high even. But if the market believes this narrative that AI is going to start eating Gartner's lunch, then definitely this is a stock to stay away from. Otherwise, I'm keeping an eye for a sign of life and a buyable sign of life for Gartner, ticker symbol IT. Now, since the software companies have been getting hit, I took a look at IGV, which is the ETF for the iShares Expanded Tech-Software sector. And yes, this is part of the bearish divergence, I believe, but it's not doing so badly. It's just above its all-time highs, or it's trading around the former all-time highs. So it's kind of hanging in there. And it doesn't show the weakness of some of the major names underneath, like CRM. So I'm keeping an eye on this. As I mentioned before, my concern is that this narrative about AI eating the lunch of software providers could start to grow in the coming months and quarters as OpenAI releases more and more powerful models, and so do the other platforms. So that's one to watch. Spotify is one I wrote about. I said that I wanted to hold this for the long term when the stock fell 11.6%, and what I thought again were okay headline earnings. I went ahead and bought some more shares, and that so far has turned out pretty good as Spot has recovered all of its post-earnings losses, and it's challenging resistance at the 50-day moving average, so it's looking good. Hopefully, this is one I can indeed hold on for the long term. All right, let's go ahead and close this out with two stocks. First, Dell. Dell Dell Technologies, ticker symbol DELL. I am in this one. I've written about it. It had a nice 200-day moving average breakout. I did the rare thing of adding to my holdings on strength, which actually is technically the way you should do it. And it's paid out so far. Dell has almost closed the post-earnings gap down from all the way back in November. If it can get above that, then it should be all clear to test the all-time high. I believe this all-time high, yes, back in 2024. All right, I'm saving the best for last, Apple. Now, admittedly, I am short the stock through one of those one times bear ETFs. I had my reasons, and my reasons have almost completely melted away. Actually, I think the reasons are still there, but now there's stronger reasons to be bullish on Apple again, at least for a trading opportunity. I mean, this is just mind-boggling how there must have been a lot of pent-up demand for Apple stock, ticker symbol AAPL, because once Tim Cook did that deal with Trump to invest another $100 billion in US manufacturing, Apple soared 5.1%. I thought that would be the bulk of the move, and then it gapped up the next day, gained 3.2%. And then today, the buyers still hadn't had enough and 4.2% gain. So I think all in all, about a 13% gain since Apple and Tim Cook made that deal. Very impressive. Apple is back into bullish territory with a surge above its 200-day moving average breakout. But now it's, of course, overextended well above its upper Bollinger Band. But something tells me that's not going to matter a whole lot in the coming days as the frenzy is on to grab Apple stock and use it as a catch-up play. All right. That's all for now. Please, as always, subscribe to the channel if you haven't already. Like and share this content so the algorithm will know what's up. And if you have any questions or feedback, you can leave them down below. Thanks for checking in and hanging in this far. I will see you the next time. All right, take care.